I might get in trouble for saying this, but buying an Airbnb for the tax savings and the cash flow is such a simple, no brainer move that it makes sense to do one right before the end of this year with barely 90 days left on the year. So, in this video, I'm going to share what I shared with 80 other people on a call who are all interested in buying a cash flowing, tax saving Airbnb. Number one, for the tax savings, and then number two, making sure they're doing it in the right market with the right design enhancements. And I actually review some deals on this call. We talked about tax savings, we talked about material participation, how to make sure you're doing all the stuff needed to actually qualify for the tax savings this year. So enjoy. And real quick, if you're new to the channel, my name is Nick Corum. We run My B&B Accelerator. We've helped 200 plus clients close on over 360 homes in the last almost 4 years. We have a 95% done for you offer to help you find and negotiate a cash flowing tax saving Airbnb and help you maximize the cash flow with all the post-close enhancements that you'll need once you close on the home. And we'll even connect you with CPAs who have a proven track record of helping clients maximize their tax benefits. And we'll even introduce you to a cost segregation study company. So if you do want to work with us, click the link in the description. Otherwise, sit back and enjoy the next 90 minutes or so of breaking down everything you probably want to know before you buy a short-term rental this year. Now you see, okay, beautiful. All right, let's do this. Let me do it one more time. That'll be good to go. Cool. All right, it's Mac. Sweet, guys. Let's do it. So how does this all work? So why short-term rentals? Why now? This is typically you guys on the left-hand side of the screen. You guys are making a lot of money, end up losing a lot of money. That's why we're all here. Ideal scenario is you guys make a lot of money every single year. You guys buy a property instead of doing nothing, and you end up somewhere over here. You guys know this. That's why we're here. This is all of us collectively on the wealthy hamster wheel. This is probably like $100 million. Maybe not $100 million. This is like $10 million in income minimum on this call. And everybody's losing a whole lot of it. So you guys have seen the scenarios. You guys get why it makes sense to do this stuff right now. So let's get aligned on quickly. Current situation sucks. Making a lot, but losing a lot. Majoring in the minors, to quote Jim Rohn. Any Jim Rohn fans on here? The guy that influenced Tony Robbins. Any old heads in here? Anybody like him? Majoring in the minors, but not actually addressing the main thing, which is we cannot move forward losing 22 to 38% of our wealth, of our income, literally every single year. You guys typically on these calls have like $110,000 to $350,000 tax bills every year. I don't even have people on my team that I pay $110,000 to $350,000 a year. That is literally insane. That could buy me like 3 really good team members for the type of company that I run. So we're clear on the cost of inaction. You guys have sense of urgency. That's why you're all here. So let's quickly go through a scenario, right? So average median household for a lot of the clients' households that we work with, they're at around 600K. So a lot of people are in this range after they buy a property. So they go from the left-hand side to the right-hand side. I'll make this a different color so you guys can see. Left-hand side to right-hand side after buying a property. You guys know this. You guys know that you can take offset. You know that you can take bonus depreciation. You know that there's material participation needed to qualify for this. So the order of operations, and then we'll get into the fun stuff. Buy a cash flowing, tax saving Airbnb. Get it live as a short-term rental this year. Get your 100 hours in, which I'll talk about. I'll draw and redraw everything for this one for you guys live. Get the 100 hours in so that you're able to not only maximize the cash flow, keep everything as turnkey as possible with somebody else managing it for you, but get the tax benefits and work with a CPA who's actually going to help on this. And then do this every single year, basically until you retire, or ideally every single year until you retire early. All right, 4 things. You guys know what bonus depreciation is, that thing you get when you buy an asset, and you're qualifying it as an active income activity. That's why long-term rentals don't work, because with short-term rentals, we are able to offset that active income because this is a non-passive or active income activity. More on that later. The short-term rental loophole is that thing that allows you to take bonus depreciation on active income stuff because you're not a real estate professional. And I'll talk about the 4 types of statuses that you could qualify for, which you probably won't be able to. And now the 4th one, which isn't a real estate professional status, it's this loophole that allows non-real estate professionals to do this, so long as they get their material participation in the 100 hours, which I'll go through that example in just a moment. The final thing that you're going to order, and this is going to be next year, you're going to order a cost segregation study, or you can do it right after the close. Most clients do it, a month, 2 months, 3 months before they file their returns. The cost seg study is that thing that's going to spit back a number that indicates how much depreciation can you take on the asset. So in this example that I drew out earlier here, let's go through Peter's example first. So this is literally live client example. So bought the home for $950. He and his spouse traveled to Shady Shores, Texas, We're helping Peter buy another home, literally, I think like 15 miles from that home right now. Actually, it's not 15 miles. It's actually closer to Frisco. It's a little bit, I think, north of Dallas Fort Worth. Not too far from the Dallas Cowboys Stadium. So found him a killer deal, waiting for the seller to accept. Fingers crossed. So bought the home, spent time, knocked out his 100 hours, got the property live in that calendar year. He literally went live the following month. Later that year, so he could have done this at the beginning of 2025 before he files his returns, or he did it, later that year. He ordered the cost seg, and the cost seg study indicated the amount that he was able to offset, and it arrived at 313 grand. So let's go through an example. Okay, I'm going to pause really quick. There were some people who joined. No questions so far. Everybody good? Because I'm about to go numbers heavy on you guys. Throw 2 in the chat if that's okay. Throw two in the chat if you're good. Throw 3 in the chat if you are completely lost and want to quickly get clarity on something. Everybody good? Still good? All right, let's keep going. All right, I'm going to reshare my screen here. Give me 1 second. All right, boom. There we go. All right, cool. So you guys should be able to see this. Okay, let's use another example. So the home that I was referencing, this is actually a client whose home just closed, I think like a week ago. So this is Pratisha's home. Let me pull up the thingy here. There we go. Okay, so now you guys can see it. So purchase price, $949. No questions there. Okay, pop quiz. Can we offset land? Can we bonus depreciate land? Drum roll, 3, 2, 1. No, you can't offset the land. So what we needed to do was we needed to back out $180,000 associated with that purchase, which was land value, which land is non-depreciable. You can stomp on it, you can pee on it, you can dump oil on it. The IRS does not recognize that land depreciates against your total taxable income over time because that land's theoretically been there. It's literally just dirt. You can't make anything worse about it. It doesn't depreciate in value. The valuation might change, but it's not something you can offset. So when we subtract out the land value, we get what's called $960K in, I'm going to switch over to my white thing here, assessed value. So this is the dollar amount that the cost segregation study looks at, or the cost seg study company looks at to determine, hey, of this assessed value, of everything that's above ground on the home, that is non-land, what can you offset? What is the lifespan of everything? And that's the thing that they're going to look at. What is the lifespan of everything on this home, or what is the estimated lifespan of everything? So the way that this mathed out, which I didn't draw here, which I'll draw here right now, 20 years. Somebody quote me. I don't know if David can quote me. I don't know if anybody else is on here. When I've looked at my other cost seg studies from other deals that I've done, what I've typically seen is they categorize, and I've used different cost seg studies throughout the year. I have seen different cost seg study teams put in different levels of granularity on how they categorize everything. But I believe the last time I spoke with a CPA, and you guys tell me if I'm wrong because I'm not a tax professional, I always thought it was anything 15 years or less in a lifespan. But I think when actually looking back on some of my cost segs and clients' cost segs, I think they offset everything 20 years or less in estimated lifespan. So maybe David, I'm throwing you my lifeline. Maybe you can chime in and confirm whether I'm accurate or not. But I'm pretty sure, based on looking at the cost segs and then seeing how they amortize everything over the timelines, that it was 20 years or less. Okay, so we're back in here. Okay, so everything in that home, 20 years or less. So the roof, that one that we ordered on the cost seg, that was a 20-year lifespan or less. All the appliances, all the furniture. There's a $15,000 putting green on that home when we already bought it. We didn't need to add that thing in. Appliances, countertops are going to last more than 20 years. The flooring, I think it was estimated that this flooring was not in the greatest of shape. It's going to be less than 20 years. Some of the drywall, some of the other appliances, all in, the number that got spat out was this number right here. Let me switch over to this, right here, okay? So what does this look like? In addition, there are other things you guys can offset. So for example, if you work with our team, or whether or not you work with our team, if you pay us $25,000 to help you, you can also write that off as a business expense. If you pay a designer and buy furniture for 20 grand all in, you can offset that because that's something that is going against your active income business activity. So it is something that you can write off, and you could take it as a loss on your K1 income return, which is going to be that tax return that you guys file for the individual property. If you pay $15,000 to, let's say, I think I said this was a designer. Let's say you pay $15,000 to a landscaping team, or $8K maybe to a general contractor, or you spend $1,600 on your inspection and appraisal report, or you spend maybe $2,500 all in on the flights for you and your spouse to and from the property, maybe some lodging, maybe some food, maybe some other travel expenses, business expenses on the way. Well, that gets you an additional total of 72K. So when we take 269, if you guys can see it up here, I'll try and make this pen a little bit bigger for the next one, plus 72. This is an example, and that cost seg hasn't been done yet, but we asked the team who typically does it for a lot of our clients, hey, looking at this home, looking at the listing, looking at other homes that you've done in the Smoky Mountains, you've literally closed on a cabin that's almost identical to this one. 6 months ago for another client, you gave us a cost seg. Assuming the land value is the same, could you give us an estimate? So he said it was going to be around 269 for that $950,000 home, plus these other offsets. So that's a 341K drop in your total income. So quick pause. That's part one. Part one is just understanding this. So if you guys are in a 37% tax bracket, for example, for all of, like if you make, David, what would it be? Something like 780. What's the upper limit for 30? Where do you get to the threshold for 37%? Something like 580 something a year, whatever it is this year. What you guys would basically recognize is if you're taking a reduction of, what was that number? 341K on your total taxable income, you guys would reduce that and multiply it by the effective tax rate that you're in that bracket. So for some of my clients, all of that income is in the 37 and then 35 is the next stair step down bracket for all of their income. That's a blended-ish 36% net effective tax savings. That's literally over $110,000, $120,000 of net effective tax savings for them. What's fun about doing this game is if we can buy that home for all in, 110 the day we close, and then put in like 30 to 40 grand in post-close enhancements, the deal funds itself with the tax savings because you got 120 or 110 in net effective tax savings out and you put 120 in or 110 in on the down payment of the closing costs. And then after that, Pratish and I were actually just doing his call today before he flies to the property tonight. He's going to put in around $35,000 worth of enhancements post-close. He's probably going to cash flow really nicely on this property. I think we projected 20 something thousand in cash flow this year. It's already an existing short-term rental. The same co-host is going to stay on. He's adding in a fire pit. He's adding in a mini putting green. We're probably adding in $8,000 worth of design work for accent walls. We're going to repaint the living room. We're actually going to restain the wood in his living room, and it's going to look super sick. He's going to spend 35 grand to enhance that thing, and it's going to cash flow 20 grand a year. So 100% internal rate of return on the down payment and the net effective tax savings, close to like a 50 to 60% internal rate of return or cash on cash return for all the enhancements that he's putting into the home post-close. Pretty cool, right? I'm going to talk about the material participation stuff next. Do you guys have any questions? I'm going to go one by one. So Eric G, what's up, Candace? What's up, Andrew? Andrew was already chiming in. Good to have you on here. Sergio, I think you spoke with Connor yesterday. I saw the intro. Excited to work with you. David's still on here. Samir, Sudar. Yeah, Gary, go for it. I'm trying to ask people to unmute. So yeah, go for it. If I didn't unmute you, let me know. Go for it.
So maybe this isn't your area, but maybe one of these tax people might chime in. It sounds to me like this is a great, if you already were considering how you can, let's say you have a ERISA-based asset slotted in an IRA and you want to get it into a Roth, I never can make those numbers make sense because of my tax bracket. Even if I Okay, so
Mhm.
now if you do a cost segregation and you drop your tax bracket that year, that to me lends more plausibility than to doing maybe some Roth conversion. Or am I looking at that wrong? Because my
Um,
tax rate is less than that year.
you're gonna have to school me on what a Roth conversion is, because I can guarantee you I put $0 into any Roth in my
Ah,
entire life. I am all real estate, crypto, and stocks. So
okay.
Is a Roth conversion
A Roth
literally just
IRA is just is
it's
money that you're
repurposing
putting in.
the yeah, you're just
It's
basically buying
taking
real estate within your Roth.
dollars I put in that I haven't paid taxes on
Right, right.
and then getting them into an account that I will not have to pay taxes or required minimum distributions when I'm have to take them.
Don't know. I've
That to
had
me
clients
is
ask, yeah. That'd be cool if you
that's
can
a
do that. If you can,
powerful,
yeah.
yeah,
Don't
because
know.
that's a double win.
Exactly. Yep.
That's a big deal.
I've had clients ask that question before. I think what we've ended up doing on almost every deal is they do have the liquidity, like they have the cash on hand. You definitely need to talk to a CPA on that. You're literally
Yeah,
asking the wrong. I'm the only guy on this call who has no money
gotcha.
in my Roth. Yeah, so I don't know that one. But I know clients have asked, and maybe a client has used his funds from his Roth and done what you've referred to as a conversion. Ethan, tax savings or deferral? All of the savings come due when we sell the property and want to spend the money. So, Ethan, if you're still on here, I'll ask you to unmute. So the true label would be it's a offset. It is a deferral process. So it's an eternal kicking the can down the road process. What most clients will do is if and when you decide to sell the property, you would take the proceeds from that sale and you would do what's called a 1031 exchange to deploy those funds into another deal so that you don't have to experience what's called tax recapture. What I personally will do is I'm not going to sell any of my short-term rentals except one, and I've now done a double-digit number of short-term rentals. I will probably not sell any of these except one that's gone up very significantly. It really wasn't a good deal for me. It was a very YOLO move. I did it the year I sold my business. I just needed a ton of depreciation that year to offset my income. I will just be doing cash out refis. So I will take a loan against the new appreciated value of my asset, the short-term rental, and I'll just get an appraisal. For example, I bought a home I think for 730 in Sarasota, Florida. This is almost 3 years ago, beginning of 2022, and now that home somehow is worth like 980 right now. So a massive, massive, massive upswing. And also, I got very, very lucky on this deal. So I'll do instead of selling that home and then 1031ing it into something else. That home crushes. Sarasota, Tampa, crazy, crazy market for real estate, by the way. Um, I will hang on to that one and then just go to my lender, Bart, who works at Chase. I do all my refi stuff with him. He already gave me a quote for $0 loan origination fee, and he gave me a rate estimate for what he can get me on a 80% loan to value ratio loan. So he'll give me 80% of that new value of the home. I'll go and take that amount. I'll pay off 590,000 or whatever I have in debt, and then I'll be left over with close to like probably after everything all in. I think it's going to be somewhere between like 170 to 220. It just depends what the appraisal comes back at when I probably order an appraisal on the home next week. So we'll see. Kaushik, we have existing mortgage on the primary home. To buy a short-term rental, what is the eligibility criteria for second mortgage, assuming I have cash down for a down payment? Yeah, great question. I'll take you off mute. So criteria that a lender is going to look for qualifying for a secondary home loan is number one, do you already own a primary residence or do you have occupancy in that residence for I think at least like 6 months, even if you don't own it? And the second one is going to be is the property that you're looking at getting pre-approval for the secondary home loan is at minimum 50 miles away from wherever your primary residence is. Um, Other stuff would just be like minimum, I don't know, 660 credit score, debt to income ratio that's less than 40. But I think everybody on this call makes so much money and has so little expenses relatively that pretty much all you guys would qualify. So great question, Kaushik. Shaw, good to have you on here. Ricardo, Jolie, Bowie, Tobes, Jonas, Samir, Sudar, I got you in here twice. Cool. Do you guys have
Hey,
anything else? Go ahead and take yourself off mute. Yeah, Jolie.
so one thing I want to know, like I know a lot of people are doing Airbnb and stuff, but there's one question. So in case like people are talking about, I'm not sure, but people are talking about there might be a recession next year. I don't know, but the inflation might go higher and something like that. So in case somebody buys a property like that and they're doing Airbnb and I will build like three, four, five, six properties portfolio. So the traveling goes down because people are trying to save money and all that. During that time, like what will happen to the properties because the amount that you're spending on the property is kind of pretty much constant per
Oh,
month.
the people who do 1, 2, and 3 bedroom homes who are competing with hotels, they'll get kicked in the nuts.
Mm.
Like they will get destroyed. The people who will do pretty well are the people who buy larger homes, like 4 or 5, 6, 7, 8, 9 bedroom homes for 500,000 to 1.4, 1.8 million in purchase price. Because Airbnb's product market fit is pretty clearly defined. It's group travel. And even more specifically, it's luxury or premium group travel. So you need to understand that the people who travel, when you're competing with hotels, when you're buying 1, 2, or 3 bedroom homes, that's literally 80 to 90% of almost every short-term rental market. So there are like literally 2 million listings across Airbnb and VRBO, according to a recent AirDNA screenshot that I took like a month ago. When you
Mhm.
filter, it's 70% of those listings were between 1, 2, or 3 bedroom homes. That does not also factor in. Somebody can do a quick chat GPT search. I did this search and I think my number was way off. I saw something like it was either 50,000 hotels or 50,000 hotel rooms. That seemed way, 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 way low. So I think it's 50,000 hotels and maybe like 6 million rooms or something like that. Airbnb is around like 30 to 60% of the entire short-term rental market. Like for you guys who aren't aware, it's massive. Airbnb's multi-billion-dollar valuation, it's massive. It's not going anywhere. Well, their product market fit is really group travel, specifically luxury premium group travel. So the homes that are always going to do well, regardless of is there a recession, is there a boom in the economy, it's literally always going to be, there are always going to be affluent people who still want to travel despite
Mm-hmm.
COVID. You saw that in 20, everybody saw it for reference in 2021. When was the largest travel boom that we've ever had? It was literally during a recession. Rates got dropped down like crazy, of course, but people were gunning to get the F out of their homes during a recession and during a lockdown. So, what you saw happen right after was even though people were getting destroyed, people were losing their jobs, people were going crazy, people were losing money. There was still literally the biggest travel period of, I think, history in that like 6 to 9 month period after everything got lifted. So, also in that period of time, the homes that did the best were luxury short-term rentals. So again, 4 or 5, 6 bedroom homes minimum. You have to do enhancements on the exterior. You have to do enhancements in the interior. Those are the most consistently high demand travel listings that people end up booking. So again, if you're concerned, don't do cheap stuff and don't do smaller stuff. So that's why, again, you guys see the callouts that we have in our ads. If you make over 400 grand a year, if you have over 100K cash on hand, if you ever applied to work with us, we have to be working with people who can satisfy the thesis, which that's what Airbnb's product market fit is. I'm sure there are a bunch of homes that do well as 1, 2, 3 bedrooms, but there's just insane competition to make it work. And the net effective tax savings and the ratio for what you're putting in just doesn't make sense.
Yeah. So what could be some of the other this is a great one. And yeah, somebody like thanks for sharing that, Nick. What are the other things that somebody can do? What do you think plan right now for that kind of time? So what
Other things to do to solve for what specifically?
when the cash flow is low or less than much less than what you are spending on the property?
Well, first off, you shouldn't have that scenario because the only scenario where I think you're really going to have that is if you skip a lot of the competitive advantage, revenue driving amenities that need to be added into the home to actually make that home work. So I'll give you an example. I'll literally just pull up Pratisha's design guide for this
Hmm.
home that we're working on right now. So Pratish just closed. He and I finished multiple iterations of his design guide. So I think he's actually on a plane right now, flying out to the property. So this is what our design guide looks like. And hopefully you guys can see the screen. I know it's big. First thing is here's the thesis and the one pager. So again, we remind clients on this all the time. So Jolie, what I'm saying is I'm all offense. I am saying let's be proactive and let's be so competitively good in our short-term rental business that we proactively solve for ever having a scenario where the cash flow is an issue. If cash flow is an issue, you'll revisit back to this. It's like, hey, I have a business that's not making money. I need to improve the 2 P's, product or promotion. Product is I have a dry cleaning business. I need to literally have a better solution for people who want dry cleaning. Promotion, the second P would be, hey, I need to run Facebook ads, Instagram ads, TikTok ads, other local ad generation strategies to get more people coming into my business. That's promotion. When you combine the two with a better product and better promotion, that's 95% of what most people do for getting Airbnbs that are already cash flowing, breaking even, or cash flowing negative to be cash flow positive or very, very cash flow positive. So that's what we're trying to solve for. Emphasis on luxury premium group travel. We got the thesis nailed right here, right? So therefore, there are power laws or rank order, coefficient, high leverage things that we can do in the right order. So I take clients through it every time. So for example, first thing you could explore, let's say your property's not cash flowing, or let's say we're buying one that's losing money or breaking even. Pratisha's was already doing quite well. So this one is just like, hey, we're putting gasoline on this fire. We're cooking with grease. Add bedrooms. Okay, not realistic that we're going to add bedrooms. We're not going to find a general contractor and pay them 50 grand to knock out a bunch of walls, rebuild the exterior of the home, and then just add in walls. We're not going to do that. What we will do immediately is we'll replace some of the beds in some of the larger rooms with queen bunk beds. Because one of the cool things about queen bunk beds is you can sleep 6 kids on this thing, literally. I guess 4 kids maybe. Unless you have two really tiny newborn kids like I do. I have one, my newborn son Luca. He could sleep on this thing. So maybe 5 kids on there, right? So again, beds and heads. The number one thing is, again, premium luxury group travel is the emphasis. So the number one thing you want to optimize for is, okay, we got to be able to sleep and accommodate more guests. So I lean into that thesis. And then the rest of these, I actually go area by area. So first thing that we do, we'll always look at the top performers in the area. This one was actually designed by a designer who did this for another client. This home's absolutely crushing. This is the number one 3 bedroom. And Smoky Mountains, we will do 3 bedrooms because that market does actually support demand for 3 bedrooms. This one's absolutely crushing. I think the year before this one got taken over and designed by a client, it was doing like 80, 85 grand a year. This one's doing like 120 to 130 on Airbnb. So this one's absolutely crushing. Designer nailed this one. I show this one to clients as design inspiration guides, and we literally take screenshots and plug this into our design guide for a lot of homes in the Smokies. One of my favorite things about this home, for example, people buy and spend $1,000 a night on this home on some weekends because it's a home. It's got a killer view in the Smokies. They have a killer balcony view. This photo doesn't showcase it. Can you guys see that the Tetris piece was dropped into here the wrong way? Who spends $1,000 a night to sit on a patio balcony and look at your freaking home instead of sitting over here and looking out this way? So I joke with this designer all the time. It's like, hey, when are you going to move that fireplace over here and swing that patio furniture right in here? Right? So Pratish and I were laughing at this one today, and I've probably had that conversation with like 30 other clients who've closed on a short-term rental in the Smokies in the last year. So I take a lot of inspiration, recorded this design guide call, and I sent this to the designers. We sent this to the general contractor, sent it to Brian, the landscaping team, so he knows exactly what we want to do on this home. So now Pratish is just going to show up tonight, Friday morning. I think Brian, the general contractor and the landscaping team, is meeting him there. And then Tiffany, I think, is who he elected for design because I was the lady who did that one. They're going to shake hands on Saturday morning. So we look at a bunch of comps. We figure out. So, for example, here's some free game for you guys if you decide not to work with us. Movie theater rooms convert better than game rooms in the Smokies. I'll say that again. Movie theater rooms convert better than game rooms in the Smokies. And the reason is, I have no idea what fundamentally drives that, but we see data from the top 5 to 10, 15 performing homes in every market. The higher performing ones, they always have the movie theater rooms. The lower performing ones don't have the space for it, or they didn't index for it. So, Jolie, one option that you could do is if you're losing money on the home, you could bend over backwards and kiss your butt goodbye, and just keep getting kicked in the nuts. Realistically, what you're probably going to do is you're going to revisit this exact methodical approach of, hey, I got to look at every other home in the market. I got to figure out what is driving these other homes to, so to speak, punch above their weight class in terms of income, and therefore decide, hey, what are we going to index for first? Are we going to do interior design, exterior design, or are we going to do it all at once? So we take over homes like that all the time that are cash flow positive, break even, cash flow negative. We don't care what the existing performance was. We care that the numbers make sense based on the comps in the area and the competitive market analysis that we do to actually make it work. So on average, clients are spending 15 to $45,000 post close on their enhancements, and it's typically across 3 major items. The general contractor, 5 to maybe 10K in enhancements or repairs or replacements, stapling shingles on a roof if the home's in good shape and they just need a few shingles, maybe replacing something small, doing a lot of accent walls so he helps the designer so they kind of bleed over with each other. And landscaping stuff. We have putting greens going live for like 3 clients' homes, probably Monday, Tuesday next week, and I can't wait to see the photos. Let me go through these questions here. Cal, good to have you on here. Callian, who does the promotion? Co-host or we owners? Who guarantees the occupancy rate is hitting high numbers? The co-host is going to be the one who does the promotion. So, for example, that second P, promotion, is literally just a product of getting listed on all these platforms that already get a ton of attraction, attention, and eyeballs. So, for example, what's really cool about the last 18 months, you guys have probably freaked out when you saw Airbnb's earnings report slowly going down, or rather their valuation going down. That's been long overdue. There are like 15 other platforms that are coming up and taking a portion of that lion's share of the short-term rental travel vacation market that Airbnb pretty much always had. VRBO was the first one to do it. Booking.com, Expedia were probably 2 of the biggest ones. Travel Stay and some of these other platforms were good too. The dark horse candidate for this one potentially taking over or overtaking Airbnb is Google Vacation Stays. So we have clients who started going live on there recently, started getting traction, getting bookings, and I don't even think Google actively promotes. Like, raise your hand on this call if you knew that Google Vacation Stays was even a thing. I'm almost certain that nobody even knows about that. I didn't even learn that they were going live again until like 6 months ago. That's been a slow ramp up. So the good thing is the promotion, it's pretty much self-sustaining just based on those platforms' growth. So what most clients have is they have a co-host who has them listed on like 8 to 15 platforms. I was literally just watching a Sean Rakazich video. Shout out Sean. Um, he's another Airbnb guy who has a really cool YouTube channel. He just did a video talking about all the other platforms that he and his co-hosts got live on too. And I was like, oh, there are a couple on there that I didn't even know about. So they will be the ones who handle the promotion stuff. And then in your examples, it says 65%. Well, we have a lot of homes that do way, way, way better than 65% occupancy. This is actually a popular question. Occupancy is just one individual variable. If you're charging exceptionally high as an average daily rate, you can have a lower occupancy. If you want to have a really high occupancy, you could drop your rates just to artificially inflate your occupancy. It's a blend of two very integrated numbers. Like you can, what I try and do is I try and launch homes to like 50% occupancy in the first 3 months. Clients freak out when they hear my strategy. What I'm trying to do is aggressively figure out what's the highest rate that I can charge on weekends. And then when I've actually seen a few of those bookings come in, so like maybe a week, 2 weeks, 3 weeks, 4 weeks later, then I'll kick everything over to my co-host team and let them calibrate on what they think is a reasonable pricing strategy for pricing dynamics and then any other rules for like, hey, we're gonna do a last minute discount on this weekend because we'd rather have somebody book for 600 a night and still make money on this weekend rather than having no bookings. So a lot of homes have been launched and done 70, 80, 50, 90% in the first 4 months. We have a case study of a client who said she had an average blended rate of like 82% in the first 5 months that she's been live. And she and her spouse, they both do a design company. So she also helps a lot of clients with the design work. Do you hire everyone from designer to handyman or cleaning people? Your co-host team will always have a roster of cleaning teams that they rotate through. This is from Gary, by the way. So, Gary, they'll have multiple cleaning teams for sure. So every co-host probably has like a roster of like 3 to 8 teams because sometimes team cleaning teams won't be available or they'll be booked out. So you always got to have like multiple backups. We will help pair you guys up with 5 other parties or 4 other parties post close, general contractor, landscaper, and designer for the post close enhancements, and then also a photographer. Sometimes co-hosts share the same Rolodex that we do. So sometimes clients reach out to a co-host and say, "Hey, who do you recommend in this area?" And they'll share 4 contacts, and they're like, "Oh, Nick and the team had 2 of these exact same people. They must be great." So co-host will do everything once you go live with the property. The designer, handyman, even general contractor, we literally have like a short list of like 130 vendors across 15 different markets that we pair clients up with. Gary says Wander plays in luxury space. Yep, I get it now. You're using a co-host. Yep. Andrew asked, how do you manage if you have someone stay at your place and they leave a bad review? Ooh, you hire you hire the dark web to go and put a hit out on them and tell them that I will find you. I will remove this review. No, you don't do that. Is that something the co-host team reaches out to them? Yeah, the first order of operations is you always just reach out to them privately. And again, proactive is the best type of solution here. If you know that a guest is having a bad stay, one of the first things that most co-hosts will do is they'll typically reach out. They'll typically do a phone call. They'll say, "Hey, no questions asked. One of the first things I'm looking for, just shoot me your email right now. I really feel bad about how this day has gone." It's the reciprocity effect is a Ben Franklin thing, for example. Hey, my team and I feel really bad that we disappointed you and your family on this day. We want to shoot you a $150 gift card for your favorite restaurant. I'm on, whatever the website is that they use right now. Hey, do you like Cheesecake Factory? You like PF Chang's? You like this? And then let me know which one you choose. And then just shoot me your email so I can get this thing sent over to you right now. So that's what I've coached a lot of my teams to do because the number one thing that I want to prevent is negative press about a business. So a negative review does very detrimental work to your listing and its performance. And even the Airbnb and other algorithms, they de-optimize you from the impressions there. So that's the first one. Again, you just try and be proactive on it. Like if a guest is having a shitty stay, dude, it's way better to, send them 50, 150 with a gift card. There's a reciprocity thing. They feel like they got taken care of. They're not going to leave you a super scathing review publicly. Privately, they'll give you negative feedback, but you'll just say, "Hey, I know we fucked this one up. Can you just skip the review process? Like, I get it. I'm having this call to make sure that we're aligned on how do we prevent this from ever happening for anybody else in the future." So that's the first one. Second scenario is we know of people that definitely have a solution for removing negative reviews, and we can talk about it privately. So But 90% of the time, you're like literally just being proactive about it. It's like, hey, I know we effed up on this one. Hey, let me treat you and your family to a nice dinner. Which one do you like better, Cheesecake Factory or PF Chang's? Hector asked, can you go over the 100 hours that we need to spend on the house we purchased before we start renting it? Yes, sir. So that is exactly where we left off in this presentation. So let me share this back up with you guys, and then I'll start writing through it. Cool. I hope you guys can see this. If you can't see it, let me know. Okay. So I'm going to redraw this because I drew this live in my video. Okay. So material participation. Let's talk about it. Material participation. Okay. So there are three things you guys need. Three things you guys need to get done this calendar year in order to qualify for taking the bonus depreciation amount, right? So even before that, let's start with the three things. Number one is you need to buy the home and you need to place it in service. I need to learn how to draw the Airbnb app because I've been drawing it on my. It's so bad. You need to buy the home, so purchase it this year and then also get it live on Airbnb as a vacation rental or whatever other platforms this year. So you need to buy it this year and place it in service this year. Second item is the property needs to be ran as a short-term rental. That means the average duration of stays needs to be under 7 days. Okay. So what does that mean? Obviously, anybody who's running a property as a short-term rental, the average duration of stay is going to be like 2.5 to 4 days on average. What does this prohibit? It means long-term rentals, they don't qualify, right? If you have a one tenant in here for 10 months this year, and then you switch it over to a short-term rental, the average duration of stay is like, I don't know, 20 to 180 days on the calendar year, right? So that's why long-term rentals don't work. So short-term rentals will work. Okay, so these two, super easy, not even concerned about one. This one, 100 hours of material participation and no less than any other one individual. And neat keyword on one individual. Okay? So you guys with me so far? This is what you need. Buy it, get it live this year, even if it's the very end of the year. Go create the listing, and magically there'll be two non-family members who probably find that listing and say, hey, I'll book this for $50 a night. And you magically have 2 stays. And the average duration of those stays was less than 7. So you're good on the first one, so long as you close and get it live this year. Good on the second one. And you guys have questions on how do I get 100 hours and no less than any other one individual. So let's talk about it. First, let's list off. Okay, so let's pretend this is you guys and your spouse. All right, so this is you guys. Now we want to talk about, let's do everybody else first. So number one concern for most people is, hey, I have a co-hosting team or a property manager managing the home. What do I do about them? And then also, well, what about cleaning teams? Do I need to be the one who goes and cleans this property every single time? Let's talk about it. What do co-hosting teams and what do cleaning teams do? Let's go through a journey from one individual who's the likely person to spend the most amount of time at each of these businesses. So on this cleaning team, we have Sally, and on this co-hosting team, we have Jimmy. Now, Sally, here's what the deal is. There are around 6 reservations that you're going to have every single month. Most of your weekends, so maybe 3, maybe 4 weekends, and then maybe 1, 2, maybe 3 weekday-ish stays happening at the property for 1 to 4 nights apiece. So there are 6 days per month. There are 2 hours per clean, maybe. If you wanted to get aggressive, you could say 3. So let's say 3 hours. 3 hours per clean. Okay, so that gives us 18 hours per month for the cleaning team, right? So 18, we're there, right? Okay, well, they have 1, 2, 3, 4, 5, maybe even 6 cleaning teams. But let's just pretend they only have 2, right? And Sally works at one of them and they get about 50% of everything. So Sally spends 9 hours a month. If you extrapolate that, there are 2.5 months left on the year, guys. So Sally's going to spend a grand total of 18 to 24 hours this year. If you guys were to buy the property in January and get it live in February of next year, Sally might spend 120 hours in the calendar year. Either way, not concerned about her, right? So cleaning teams, just exit out, okay? Not concerned. Let's talk about Jimmy, though. Jimmy is obsessed with your short-term rental business. He loves you. Jimmy overworks himself to the bone. He spends 25 hours in the first month. That's month 1. And then each month after that, he spends about, let's say, an hour a day because he just loves your business so much. He doesn't ever spend a day where he doesn't work on your business, okay? So 22 business days every single month. So that's 22 hours in a single month. There are 2.5 months left on the years, guys. Let's map this out. Let's say he spends 25 plus, let's say 2 times 22. That's going to get us to, drum roll please, something very close to 44, 64, 69 hours. Okay. We're not concerned about the co-host team. Because again, there's no one individual who's spending more than 100 hours. Okay, now let's focus on you guys. This is you and your spouse. Now, what's cool is when you guys file your returns together jointly, both your guys' hours get to contribute. So here's the deal. You guys are going to do it across 2 different big ticket items for spending time at the property. Or sorry, I spilled the beans there. For focusing on material participation. The first one is you guys are going to get on a I should never draw again in my life. You guys are going to get on a plane, fly to the property. And what are you guys going to do while you're at the property? Well, probably spend an extended 3, 4, maybe 5-day weekend, kind of like Pratish is doing. He's flying out there tonight. He's going to fly home Monday or Tuesday night. Spend a grand total of all of Friday, Saturday, Sunday, maybe Monday, and then maybe half of Tuesday, so 4.5 days. Let's say he does that. Say you spend 4.5 days, and then roughly 20 to 26 hours per day. Because what's happening? Pratish and his spouse, you guys are probably like them. You probably crushed 10, 11, 12, 13-hour days for work before. Am I right? So while Pratish is there, he's also going to take that same bulldog mentality and just work like crazy on his property. And what does work like crazy on his property look like? He's probably overseeing the general contractor, landscaping team, and designer. While they are there, Pratish is supervising those people so that they deliver excellent work. Now, those guys are there for probably 10, 12 hours each day, and they're there for maybe like 2, 3, 4 days as well. So Pratish gets to log all those hours. And guess what? Same thing with the spouse. So if they're there for 4.5 days and 20 to 26 hours per day, I think that comes out to 90 to, what's 4 times 26? 104 plus half that. So 104 plus 13, that's like 117 hours. Okay, cool. All right. So they're logging quite a bit of hours right up front. Okay. Literally on the first 3, 4, 5-day weekend. In this case, it was 4.5 days weekend, right? If you want to be conservative and say, hey, I'm only going for 2 days. Okay. Cut these numbers in half, right? Now the property is live. Let's talk about phase 2. So that's phase 1. Phase 2, here's where you're also going to get a ton of material participation. Home goes live on Airbnb. What do you think every client does for the first 7, 14, 21, 28 days that the property is live and they're getting bookings? They are on their phone checking the Airbnb app for 30 to 60 minutes per day. And what do you think they're doing on that app? Are they just suddenly real travel enthusiasts and they're trying to find a bunch of other vacation spots for them and their family to go to as time goes on? No, they're overseeing the co-host team so that they don't F stuff up with the messaging that they send out to the guests. So they're reading every message. They're obsessing over this business. So much so that they're not doing the grunt work and the heavy duty legwork of messaging those guests, solving their problems. No, they're overseeing it. Some of you guys on this call are project managers, quality assurance, quality control guys at your businesses. You guys see that your team does stuff all the time, and you guys have to sometimes crack the whip or be very, very, very on top of what they're doing. So you have to ensure that the quality of work is actually really, really good. So 30 to 60 minutes a day adds up pretty quick. That's 3 to 7 hours a week. And guess what? Both spouses typically do that. And I've seen clients literally take screenshots of their screen time app on their mobile device. So if you have an iPhone, screen time app literally does this for you. You can see all the apps and you can literally export this log and you can substantiate that in your notes doc, which you'll present with your tax. Well, actually, you'll keep that handy for your tax returns next year. You won't actually submit it, but you'll have it handy in case the IRS ever comes knocking. So knock on wood, over 220 clients, over 360 closes. I haven't had a single one go through an inquiry or a probe or an audit because they're doing this 30 to 60 hours, minutes, or I'm sorry, 30 to 60 minutes a day. So that's 3 to 7 a week. The math's out to pretty aggressive number. I'm going to stop sharing my screen here because I'm running out of screen real estate. Most clients will also log like 20 to 50 hours in the first month of going live on the property because they'll also talk to their co-hosting team. They'll be like overly obsessively involved, even though the co-host team doesn't want you to do anything. But it's pretty easy to substantiate. If you're on the toilet for 30 to 60 minutes a day, maybe that's a lot, maybe that's a little. Actually, that sounds like a lot. That is probably a lot. But now that we have phones, we're probably all guilty of that. Throw a 5 in the chat if you're on the toilet for 30 to 60 minutes a day. numbers make sense. So if you guys have questions, go ahead and take yourself off mute. And I hope for whoever asked that. Hector, does that make sense? Let me see if I can find you so I can ask you to take yourself off mute. So Hector, good on that. I'm also admitting like six people who are in the waiting room apparently. Doug, yeah, that's really cool. Yeah, Toggle is also really cool. What I've discovered is it's literally native to your app. So this one. So if you're Android, I don't know if you guys have a like a screen time app. So I'll show you guys mine right here really, really quick. So this is mine. So again, this thing is literally going to showcase exactly how much time you've been spending on the phone and then what apps, like if I were to go one step further, oh my God, you guys are going to see how much time I waste on stupid stuff. Okay, so this is what I've spent on the past week out here, right? So what it showcases is, oh, that's how much time I spent on the app this week. And what clients will typically showcase is, oh, I'm spending 3 hours a week on Airbnb. What do you think you're doing while you're on there? Literally tracking time or work. That's your clock in sign. So I hope that helps. Andrew, yep, we can see. Cool. Samir, if you buy a duplex and rent one unit out as a long-term rental and the other part as a STR, would that still work? Dude, no idea. Why would you do that? Why not rent them both as a short-term rental, or both as a long-term? Um, I don't know. You could probably ask your CPA to ask a cost seg study company, hey, can you split the home in half and then do a cost seg on this half of the home that's being used for short-term rental? I imagine that you could. I literally don't know. Callian, yes, great insight. There are certainly 24 hours in a day. Did I say something otherwise? I said maybe 24 hours in a day, 16 waking hours in a day, 8 hours of sleep. So no, 16. Oh, well, you can't log. Maybe that's what you were suggesting. Well, you can't log the hours that you're asleep. The litmus test that I've always understood from CPAs is, and again, just through court case law reading, it's material participation to the extent that if I didn't do this thing, can I make the case that the business materially suffered as a result of my lack of participants or my absence on this, right? So, for example, when clients ask, "Hey, can I write off the travel time to the property if I take a flight from San Diego to Nashville and then drive 2.5 hours or whatever it is, an hour and a half, I think, to the Smoky Mountains?" I would say, "Well, what are you doing during that flight? Are you sleeping? Are you watching Netflix?" That's not going to be something you should be substantiating as your material participation in the business. And by the way, you don't need to. You can chill on that flight. You shouldn't log those hours because you're going to get so substantially many hours from just literally participating in the business, as we've discussed. So if you guys don't skip the 2, 3, 4 day weekend, and also, don't just completely check out as soon as your property goes live, you and your spouse will comfortably log 120 to 190 hours in probably the first 2 to 3 months after you close on the home. Cool, guys. Let me see if there are any other questions. When you listed 20 to 26 hours a day, you meant for two spouses. Yes. Thank you, Bowie Pat. Yep, exactly. So, Callie, and I apologize if I didn't make that clear. Yes. When you're logging 26 hours a day, it is definitely across two spouses. So maybe around 10, 11, 12, 13 hours a day. So 20 to 26 hours a day. I completely missed that. So my fault. I didn't mean to. There are 24 hours in a day. I was like, yes, there certainly are. And maybe I'm just bad at math. All right, Andrew Archett. Oh, Archett, good to have you on here. Arun, good to have you on here too. Excited to work with you. I'm just going to ask all you guys to unmute. So the first one, floor is yours. Eric, what's up? Good to have you on here. Florin, just admitted you. Frank, Hari, Hector, Herbert. Oh, Herbert, Herbert? I know you got a billion questions. Really good questions, by the way. Frank or Archett, the floor is yours. Let's start with you guys. Going once. You guys are both off mute.
I just unmuted because you asked, so I
Oh,
didn't have a question though. Thank you.
dude, what are you here for? Bro, we're talking about real estate. Are you buying a short-term rental this year? I'm just messing with you. Archit, yeah, let's go for it. What's up?
Yeah, same. I don't have any questions. Just wanted to hear and maybe see if I have other questions I'll add later.
Okay. You guys looking at information or are you guys looking to take action on stuff? I'm very, very, very happy to support you guys. Yeah, Doug just asked, can we review some hot areas? Yeah, we'll do that. We'll do that to wrap up the call. But I'll give you guys another like few minutes to quickly just, again, I'm pausing because I know you guys got questions. Dongo, what's up? David, I see you're still on here. Good to have you. Eric, let me go back through these. So Florin, Frank, I know some of you guys joined late. We were just finishing the tax material participation stuff. So I'm not going to cover that just because 30 people are on here watching that. So anybody else, go for it. Frank, Samir, what's up?
Yeah, no, I'm one of the ones that joined late, and I apologize. I
You're
keep
good.
seeing these on my calendar, and I keep wanting to join and and participate and understand a little bit more. So which had some questions, but I did come in late, so I missed a lot of content. I see it's being recorded, so I'm assuming the AI notes will be shared with everybody, so I can
I'll upload
take
this on
a look.
YouTube. Yep.
Oh,
Yep.
okay, cool. Okay.
Yep. So, Donga, can you review tax benefit like bonus depreciation? I'll shoot you the recording because we literally just spent like 20 minutes doing that. Andrew, do you need to form an LLC before you start the process? At what stage is that needed? Technically, no. I mean, we enroll clients all the time. They have no LLC formed. And then on the onboarding call, I give them insight on forming in California or forming in Montana or Wyoming, which is typically where most clients will do it. Majority of clients form in Wyoming for the anonymity, which is cool to have nobody able to skip trace or reverse look up your name, phone, and email or phone number specifically. What I do recommend is everybody should form an LLC right after they enroll with us, and then a week later, do one business checking account, so formed with that LLC, so that you have one LLC, one short-term rental, one business checking account, one credit card, and then there's uniformity with a really clean profit and loss statement. Um, I've made the mistake, and not a mistake, but I've made the bad decision of buying multiple properties in the same LLC, and typically it's a result of bringing in partners on deals, and then it's just an absolute shit show trying to track what expense, what income came from what thing. We got to hire a bookkeeper to bog all the reconciliation and tagging for which home it was for what. It's like we pay a bookkeeper $100 a month to do this, but like, dude, I spend like an hour a month giving feedback on what this stuff is, and I just like literally hate it. And an hour of my time is worth a lot, and I know you guys an hour of your time is worth a lot too. And then Doug, I won't skip your. We'll do the hot areas after we die down with the questions. Doug also asked, getting mortgage for STR is best with personal loan. Any recommendation by using LLC loan? I think the most traditional way that most people buy short-term rentals is to use a investment product for full doc 20-25% down, whether it's a DSCR loan or a 20% down, 80% loan to value investment loan product. Since most lenders are very, very cool with you using a secondary home loan product, which is either 10% down if it's beneath a certain conforming limit for the loan amount, which amounts to around like 880,000 in purchase price. If it's over 880K, it's a 11 to 15%, typically for most lenders, 11 to 15% down payment amount for the secondary home loan. So I'm a huge fan of those. I've personally used two. I still have two in existence. Every individual, a lender should be able to approve you for two per individual. So if you guys are married, filing jointly, you'll get four per household, I believe. So that one's pretty common. If you have any questions about that, let us know. But yeah, it's very useful because it allows you to keep the entry very, very low down payment, very low closing costs. Um, Hector, did you have any questions? I see you took yourself off mute.
Yeah, well, thank you for the response on the 100 hours. I did have a follow-up question. So
Mhm.
if I already have an LLC,
Mhm.
and does it matter about the 100 hours, or is that just when you're, on W-2s and you need to put both you and your spouse? Is there any difference when you have an LLC regarding the 100 hours?
Good question. There is no difference. So you'll need to get the 100 hours logged no matter what. So if you have an LLC, an S corp, a C corp, doesn't matter. You still need to satisfy those three criteria. And maybe you joined late, but since I have this one handy, I can just quickly
No,
share
I got
this.
it. I was in for the criteria.
Okay, cool. Yep. So that's it. Yeah, you still need to. Yep. Cool. All right, going once, going twice. Otherwise, I'm going to do one Andrew wanted. So Andrew, let's do this. Hopefully you're still on here. Where'd you go? There you are. All right, purchase price range. Give me a purchase price range in an area. We discussed some of the areas on our last call. Andrew, you gotta. I'm doing it for you, buddy. I also know we're
I
gonna get
really
started here soon.
appreciate it. I'm learning a lot. I'm quiet because I'm taking so many notes, but thank you.
Such diligence. How about the Smoky Mountains? How about Southern Florida? How about Poconos, Pennsylvania? How about Austin, Texas? How about Broken Bow, Oklahoma? Choose one of those. Doc, all right, I'm literally gonna choose for you again. Okay, so here's our deal portal. Oh, I'm gonna flash it. Oh, don't want a billion people stealing all our deals. Actually, I'm not gonna do that because we do have somebody who little snake. We have a wholesaler who was in our program and he started snagging deals. He started DMing our clients. I was like, you fucking piece of shit. I'm on good spirits though. It's okay. I will show you guys a really cool one that we have a client, hopefully. I think we actually just submitted an offer on this one. So, oh, Doug, he said, or Andrew said, not cool. Oh, no, it's all good. We have way better, way better set of deliverables than I think just about anybody in the space. Well, what do you guys want to see? Somebody else give me a quick you said hot areas. Any good spots in Cali? Hector, I'll say no really quickly. We don't do anything in California, New York, or Hawaii for basically the three main reasons you wouldn't want to do anything out there. Number one is regulatory stuff. California is just the least short-term and long-term rental friendly state, period. We used to contact their state for zoning confirmation, licensing and permitting, and then certificate of occupancy confirmation, and then also HOAs out there. We could not get a clear answer on, hey, is it even compliant and zoned for compliance to do a property in this neighborhood or not? They were redrawing their maps or they couldn't get clarity on their maps. Licensing and permitting stuff was also pretty difficult. And I think if you watch any of these, Graham, what's his name? Graham Stephan did a really cool video on this recently for why buying real estate in California and specifically LA sucks. Licensing and permitting stuff is literally just a perpetual dead end. You can't get a straight answer. You can't even ask somebody, hey, so what do we actually need to do to apply for a license or a permit or certificate of occupancy out here? So even if you could satisfy all those items and still make everything work, I literally wouldn't want a client to wake up in like 6 months from now and get like this notice on their door that says, hey, according to our, whatever jurisdiction that we're in right now, we don't have the authority to run this as a short-term rental and you're going to get fined daily. So New York is different for a number of other reasons, but it's just very difficult to do it out there. And then Hawaii, I just de-risk clients for them because I think acts of God, other really tough stuff going on out there right now. I'm not a fan of just doing anything out there. I think it's very high risk, and I think we definitely have better stuff available in other parts of the U.S. for sure. Let me show you this one. This is a cool example. So a lot of stuff that we do in the Smoky Mountains, and the Matt also asked Texas. Yeah, I can show you guys a deal that a client just submitted an offer on. We had a lot of clients. Actually, here, you know what? I'll find, what was that Austin one? Clarksburg, I think, was what I was showing you guys earlier. Oh, no, I was showing you guys Baxter. These are both cool offers that clients submitted offers on. So this was the creative finance one. Yeah, this one is really, really cool. The Clarksburg one is also really cool. I'll show you guys this one really quickly. I think we just submitted an offer on this one, so I'm not concerned about showing this. This is a much smaller home, but it satisfies the thesis quite well. So in 4 bedrooms, even though it's only 1,600 square feet, we could comfortably sleep like 10, maybe even 12 guests in here. So it's awesome. So like this home would be like a $230,000 home in the Poconos, Pennsylvania, or Broken Bow. But what's really cool about this one, and I've shared this thesis, I did a really in-depth breakdown on this one. When you look at a lot of the comps in the area, so for example, expenses on this one I think are going to be under like 65 grand a year. So that's like a 15% yield expense. Yeah, like 68 grand a year. A lot of homes doing like 60 to 75, 75 to 85. And then there were like 3 or 4 homes in this very tight submarket that were doing like 90 to 120. And I was like, what the hell are these homes doing to punch above their weight class? Very simple explanation. They have a pool, number one. So this home does have a pool. And then they completely decked out their backyard. So I don't think, let me see if that drone shot is available here. Okay, I think these are the best 2 photos. We have it in another folder, but for the sake of time, what we're going to do on this one is we're going to completely gut all the grass out here. And we're going to add in 2 revenue driving amenities. So the first one is this entire area outside of the tree that's over here. We're going to turn it into a mini putting green. So landscaping teams out here for whatever that square footage is, that looks pretty significant. Could literally be around like 14 to 19 grand if we do that entire area, and then also including this section over here. And then on the other side of the pool, which is this spot over here, I think we have a couple photos that show this a little bit better. But for the sake of time, there is enough space, and whether we move this rock or keep this rock here, just putting in a mini fire pit. So whatever, number of chairs that we can seat around there. If there's not enough space, we'll probably squeeze it in. And that's going to be, the final call is going to be the landscaping team. We might just slide it in over here and do a smaller mini putting green. So this is a deal that should, again, punch above its weight class. It's a really, really small one. So this is much smaller than most of the stuff that we typically help clients with. Somebody else said Texas. Let me find, where's that Austin one? Let me see if it's in our deal portal right now. Otherwise, I'm going to pull up my other CRM. It is. If you guys want other areas, let me know. Give me a moment. Somebody take themselves off mute to kill the dead space, because I know as soon as I hear somebody drop off here, I'm going to be like, oh shit, I shouldn't have stopped talking. Yeah, I only have 1 billion deals for Austin. Yeah, let me no, but I wanna find this one that we just submitted an offer on. So give me literally 15 seconds. Where is this one? What I might show you guys is I might show you guys the one that Peter Eck just submitted an offer on. Why can't I find this one? Okay, I'm gonna show you Peter's deal real quick. All right, and if there's anything else you guys want, I'm gonna try and hide. I'll try and hide the address on this one. All right, there we go. Okay, sweet. So here's another really cool example deal. Expenses on this one are going to be around 160 a year. Income's going to be around 190. Well, we submitted the offer on this one, and we negotiated some crazy terms. So I don't even think anybody can come in and compete on this one. So here's an example one. $1.2 million home. I think the final term was we're giving it to him at the offer price he wants because we negotiated a ton of other favorable stuff on this one. There is literally a super god awful ugly home that is 6 bedrooms. It's 1 bedroom larger. But it's literally an inferior home on my assessment, and I think the rest of the team and a co-host, we showed this one too, believe the same as well. So let me just show you guys on the note that we were speaking about earlier as it relates to, let me pull up the Airbnb here really, really quickly. Literally less than 3 seconds. I'm just looking for my last note in here. Okay, here we go. So this home, this is what a home that does 200, probably 280 to 310 on Airbnb every single year. So this home is almost pushing $300,000. So it's a 6 bedroom home. This one is, I think it's technically Frisco. Yeah, so this is like north of DFW, I think northwest, west, I believe. It's a cool home. I think it's just very busy. Some of this stuff is like, again, it's just too busy, right? So it's cool. It's modern-ish. Some of this is a little more like rustic, weird, overdone type stuff. Again, very, very nice home. But what we've noticed in many of these areas is more modern stuff tends to perform even better. So with Peter's home, the one that we're submitting an offer on, we pretty much have, you want to read LaShonda's review here? Check this one out. Lived up to the pics. Highly recommended property. Thank you, LaShonda, for the great review. This one is right on the water. So what's really cool about this one, I think it's this one right here. And then this is a neighbor spot. So Peter's going to have a wide open backyard space to add in the most key prime revenue driving amenities that we love to add in. So he's got so much space. We're going to do a super cheap beach volleyball court. So I think he's got the space for it. I shared this in my video breakdown that he and I were reviewing the other day. Also in the exterior, we're going to do quite a bit for a landscaping team to do a mini putting green. We'll definitely throw in a fire pit out there. He's also got plenty of space leading up to his waterfront deck. So let me show you the area here. So again, just ton of space. And I think the total acreage on this is like, I swear it was like 1.5, saying 0.4 acres lot. That is definitely not accurate because that space is massive. So it's definitely larger than a half acre. That is not accurate. And then what we'll also do is, let me go back to, scroll down here. I can check on PropStream for what the actual acreage is. What we're also going to do in the backyard is, okay, so I think I labeled the 3 things. So the mini putting green, the beach volleyball court, and then the fire pit. So that's what this whole area is going to look like. And then also what Peter suggested was, hey, what if I just put in a pool? Because I'm actually getting so much cash back out of this deal that I'm happy to put in the pool right after I close. And we added that into his pro forma and then modeled everything. And then we were like, holy shit, this is really, really good. So that's an example. And again, we looked at a bunch of other comps. Again, this was the home that I was showing you guys that's doing 260, 270 a year. This home is not in super close proximity to anywhere like super, super crazy cool. There's nothing like amazing going on with this one. Peter will absolutely crush the performance on this one, but probably not in year one. I think he needs to figure out his pricing stuff within the first like 3 to maybe 5 months. And then I would guess maybe 6 months, 6 through 18, he's probably going to do really, really well and get much, much closer to that home's performance. Really, really bullish on Broken Bow, Oklahoma right now. So for that person who wanted Texas, this is literally, what, 2.5 hour drive north of the Dallas-Fort Worth area. So we can find and negotiate deals like this all day. Plenty of newer cabins that were built within the last like 2-3 years. I'm pretty sure this one was built in 22. This one's a little bit older, 2018. We have another one. What is it? Pines is the one that, again, I think we just went under contract on this one yesterday. Not yet under contract, rather. We submitted an offer. So this one, for example, this one was built 2 years ago. So again, fully furnished, really, really nice designed homes. Broken Bow is getting competitive. But again, the thing that nobody does in their backyards is do anything to enhance the design in that backyard. So what we're going to do on this one is I have the blueprint for what we need to do up here. It's not a game room, it's a movie theater room because again, movie theater rooms crush. In almost every market, we optimize for those first versus games. And then what we can do is we can always move the games into there. Massive, massive downstairs living room area. So we'll put the game somewhere closer to there and probably get rid of one of them. Outdoors is where we're going to see the biggest transformation. So again, this is let's show the acreage on this one. I think this is 1.15, 1.12. So this one, what we're going to do, let me show the drone shot, is again, probably some sort of a sand beach volleyball court. There is literally a ton of space out here. So we're probably going to relocate some of this stuff. Their road is over here in this driveway. This is it's like a 30 car parking lot. It is over aggressively large. So you're really only going to have no more than 3, maybe 4 cars here at any one point, with each one taking 2 to 6 people in and out of the place. So we'll put in sand beach volleyball court. We could do a pickleball court, but I modeled it for sand beach volleyball. It's way, way cheaper, and I think it's better bang for your buck for now. Fire pit they already have, but I think we'll redo it. And then we could put the putting green in over here. But yeah, the drone shot on this thing is going to look absolutely sick. Here's another better shot of the driveway area. So they just have a ton of space that's underutilized. May remove the trees, but yeah, just a ton of space. And we had a client submit an offer on that one today. So if you guys have any particular topics that you want to dive into for deals and deal reviews, more than happy to. Otherwise, I'm just going to go through the questions. So Texas example, I showed you guys a couple of those. How do you manage out of state? Co-hosts. Co-hosts or property management teams have boots on the ground teams in each of the areas that they're in. Most co-hosts specialize in typically like 1 to 3, sometimes, I don't know, 2 to 6 areas. But they double down and manage like 15 to maybe 30 spots. Some slightly larger teams that have maybe a co-founder and a founder and 6 team members, probably managing like 30 to 60 if they have a really tight operation. So yeah, the co-hosting team will handle everything. You guys literally do not need to buy anything 5 minutes from where you live in San Diego. I don't know what has been going on with my onboarding calls recently, but I've been speaking to people who are like, yeah, we want to buy something like 30 minutes from where we live. I'm like, profitability over proximity is definitely the approach to take. So I'd rather see you guys do stuff in a profitable area rather than super close to where you guys are. Hector said Nevada or Utah. We've looked at Utah, looked at a lot of what is the ski resort area? Lake, what is it? George? Tip of my tongue. Jesus Christ. Something City. I know exactly what it's called. We've looked out there plenty. Park City, maybe. And then there's like 1 or 2 other areas. Yeah, thank you. Park City. Everything is just too expensive. There's travel demand, but the homes need to correct down like maybe 5 to 20% still. A good example on this, we didn't buy anything in the Smoky Mountains last year, because most homes still needed to drop another 15% in purchase price. And then within the last like 9 months, like beginning of this year, they finally did. So we bought a ton in the Smoky Mountains this year. So yeah, maybe next year Utah will finally, or maybe in like the next month, 2 months, 3 months, Park City and that other really cool resort area in Utah will go through its own correction. But again, not doing anything right now. Callian, we have a ton of deals available in the Poconos. So I think I reviewed like 3 examples. But we could do that, if time permits. Do the homes come with furniture and accessories as part of the transaction? Yeah, so 95% of the stuff that we buy, they're already existing short-term rentals. And honestly, the furniture is typically in great shape for most of the deal. So if there's like $35,000 of furniture that conveys on some of these larger deals, typically we'll keep like 80 to 90% of it. Like these really high quality bed frames, for example, like this one that we were looking at earlier. So again, I think almost every single one of these we looked at were existing short-term rentals. I really want to show you guys that one Austin one. So this one, all the beds, all the games, all the furniture will convey. Same thing for this really cool one that I just showed you guys. So again, they're light on the furniture. We'll hire a designer to add in some other stuff, but the bar stools will keep. The bed frames and the bunk beds in this one were really, really good. So that one is good. This one will probably replace. Could do something a little more premium. This was probably the lightest furniture of any existing short-term rental that we've ever seen. This is an example when we bought this one. This one was already fully furnished. I think we kept almost 80 to 90% of everything in here. You can't really tell. I don't think well, I mean, not that you can't tell. I don't think we really upgraded too much furniture wise on this one. I think the beds are actually in pretty good shape. I'm pretty sure these were the existing bed frames too. Same thing for this one for Peter. All the furniture is going to convey on this one. This one's actually really nicely designed. I think some of these walls are a little bit naked. So we'll put a massive TV on here, do some asymmetrical accent walls or symmetrical accent walls around it, maybe a mural design. But this one's pretty uppity, pretty tasteful. But yeah, this table, this is probably like a $4,000 table. We've seen other stuff like this. That can sit like 12 to 14 people, I think. I think seven on either side and one on either end, or six on either side and one on either end. So yeah, furniture is almost always going to convey, but we'll still add in a designer to replace some of that stuff and upgrade if possible. How do you know what area to where to stay away from? We've looked at almost like 2,000 cities in the last 4 years. It's just very obvious when stuff doesn't cash flow. There's a yield metric. And for reference, so Doug for Park City, this is why nothing works in Utah right now for the most part. $1 million home would need to do minimum $150,000 a year gross income to make the deal work. Because for most areas, around $110,000 to $140,000 in annual expenses will be the expenses on $1 million home. So as ratios, that's like 11 to 14% of the purchase price. That's going to be your annual expenses number. Very few markets can hit a 15% yield. So for example, the homes that do like 150 grand out here, if we wanted to buy something comparable, they're like 1.2 to $1.6 million homes. It was like, doesn't make sense. So that's how we know how to stay away from areas in terms of the income. And then the other side of that would be compliance. We stay away from California like the plague because of exactly what I was defining like 5 minutes ago. The zoning departments, the licensing and permitting, HOA stuff, just literally a clusterfuck of nonsense. Like we literally cannot even get a straight answer from those people. So that's how we know. Herbert, on average, how close have the cost assumptions in the pro forma have compared to the actual numbers once the SCR is in operation? Over the years, honestly, we've been really good. Couple big recalibrations for us were number one, we under projected electricity for a number of areas. So, for example, when it's like hot year round, we learned that we were under projecting electricity a little bit. We were over projecting, which is good, over projecting gas, water. I still have pro formas that show like $150 a month in water, and the reality is like 16. So we started calibrating on that. Cost assumptions. Couple years ago, we were kind of off on like general contractor work and landscaping team and designers. Now we're much more dialed in on that. I used to under project like what it was to work with a designer. We still find a lot of designers who charge like 6 to 12 grand for their design work, but now we've noticed some people charge like, or they quote like 10 to 20 grand for homes that are already fully furnished, which is like insanely high. When I did my very first short-term rental in 2021, I paid my business partner's spouse, Georgianne. She had already designed a few homes. I think I paid her like 6,500 all in, and spent around $14 a square foot, $13 a square foot, 2,600 or 2,400 square foot home. So it was around like 30 grand all in, I believe, not including her fee. But yeah, overall, we've been pretty accurate. We just calibrated on utilities like a year or two ago, calibrated on, I now over budget in every pro forma for the designer, the general contractor, and the landscaper. Um, so yeah, I think now we're overall pretty accurate. Jonas, does the deed title need to be under both our names for my wife and I to qualify for the material participation? No. It needs to be owned by one of you guys, and then you guys just filing your returns jointly means both of you guys can take the depreciation. So if you guys are filing jointly, so long as at least one of you guys own the property, you'll be able to take that depreciation on your joint tax return, which is because you guys are filing jointly. Callion, your average nightly rate is between low, high range, not the median. How accurate is it versus Air DNA? I don't know what that means. Your average rate per night is average between low, high range, and not the median. No, what we actually do is we look at historical income projections and then we reverse engineer from there what the likely average daily rate and the occupancy is going to be. Again, it's two variables. Here's a great example. If a home's going to do 120 grand a year, it could be booked. It'll be booked for $10,000 a month. Okay. There are two different ways to get to 10. Well, there are a billion different ways to get to 10K a month. You could book 60% occupancy. So you could do 18-ish nights for just over 530 a night. So that's 530 a night and 60-ish, pretend these numbers are accurate, 60% occupancy. Or you could do slightly lower average daily rate and you can get like 90% occupancy. You could be booked for like 27 nights. And you charge 330 a night. Different ADR and different occupancy and different ADR or average daily rate, but the same total top line income. So I'm not a fan of trying to like tell clients like this is what your occupancy is going to be. What I tell clients to do is if you want to overperform the projections that we make for occupancy, every home that's in like the 90th percentile is literally like 75 to 95% occupancy. What you want to do is become kingpin. That's the category king. So you want to be the guy who's got the best business or the best business in the space. And you want to do that in your short-term rental business for sure. For example, I would suggest, I think we're category king in the space because we are literally the only team that will help find and negotiate the deals. We try and remove agents on the deal. If you guys were on the call earlier, we talked about removing lenders on the deal. No other company does that. Nobody else does creative finance. Nobody negotiates $55,000 seller credits. Nobody negotiates 15% seller financing as a carryback on top of a deal. So I would argue, I mean, I blasted this message to you guys like 8 hours ago or something. There are 30 people on this call. Like, we have differentiated ourselves so aggressively well that guys are showing up and spending 90 plus minutes on this call. We've probably had like 70 people on here since we launched. So it's category king thing. And I obsess and think about this all the time. It's like, how can we just be unique, superior, better, and then just so differentiated and so solving what the product market fit of an audience is that that's what you need to do in your short-term rental. So when you do that exceptionally well, your occupancy numbers are like 70, 80, 90% year round. Because if you've nailed the thesis and it's group travel, luxury premium group travel, the people who want to spend money will spend it with you point blank. So for example, like that other one home, I'll pull up the AirDNA screenshot, which showed the historicals for this guy. So this guy's kingpin. When we talked about category king, this guy, for example, dude, 93% occupancy. So of the days that he was available outside of the 2 months out of the year that he almost took this thing offline, he was booked out, or she was booked out literally almost every night. That guy's kingpin. That's what you want to strive for in every submarket. Now, in some deals, you won't have a chance in hell of being the best 4, 5, 6, 7, 8 bedroom home. For my clients who want to do more luxury stuff, which if you get into the $1 million plus category range, Peter's going to snatch that throne. Yeah, Peter and I were talking about that literally 2 days ago. So he is going to aggressively outperform that one because he's going to add in a bigger, better pool. He's literally on top of the water. Nicer, I think, nicer home. It's 1 bedroom less, but he's going to smoke that one. So kingpin. But if you're in a market and you want to do something smaller and you can't necessarily, add in like $120,000 of enhancements post-close to be the number one. An example would be this one's also kingpin. They're the best 3 bedroom short-term rental in that submarket by like almost like a 7 mile radius, maybe even 15. Let me pull this one up for you guys. Where was the other one? So this one right here. So again, this one's doing like it's like 125 to 140 a year, and we look at this one on AirDNA all the time. So top 10% of homes, so they're in the 90th percentile. Again, for 3 bedroom homes, this is like if you were to design this from nothing, I would say around like $15 per square foot, and it's at least 2,000 square feet. So maybe like 30 to 40K of furniture, and then paying the designer 12K, and then that sauna plus some of the other small stuff. Like for 50 to 60 grand, if you closed on this $750,000 cabin, which is probably what it was, it's an insane cash on cash return. That's like a 20 to 25% COC. So really good cash flow. Cool, guys. Who wants to work together? I would love to support you guys. I'm going to shoot you guys my link here. I'm also going to send a message after this call. Don't leave before you guys get a link on or get a time booked on my calendar. Let me actually make sure I have enough space. So it's going to be with either Connor or myself. No, this one should be with me. So let me get you guys added in here. Yeah, take a minute, guys. I know as we're trickling out of here. Also answer some questions while you guys are scheduling. But I'm going to drop this in the chat. So, don't leave yet. Schedule if you guys still want a short-term rental. Actually, why don't I do something special? I'll kick everybody out of here who isn't buying something in the next like 45, 60 days. Throw a 6 in the chat if you're planning to buy something literally before the end of the year and you want our help because I'll work more closely with you guys on this call. HKS, I recognize your initials, but I don't know who you are. So Praveen, you trying to do anything? Andrew obviously is. Samir, Donga, I know you were speaking about this. Lawrence, Archit. Archit, dude, we got to move forward on something. Hari, oh, that's you. Nice, sweet. Okay. I give discounts to people who spend more time in the group call settings, and then I don't have to work as aggressively hard on the one-to-one conversation, so I don't need to overexert myself. I'll give you guys special pricing. Same thing I did on my last discount, or on my last webinar. Vishal, what's up? Good to have you on here, sir. VJ's live and on. And Kaushik, you can ask those questions right now. When we launched the program, we charged 25 grand per deal in 2022. And then 23, we ramped the prices. 2024, I think we were charging like 27.5 on some. Did a couple 30,000. I think that was the upper limit of our program fee where I lost product market fit. And then beginning of this year, oh my God, Trump's inauguration slowed the real estate market to a halt. And 40% bonus depreciation also did too before July happened. Um, the discounted rate that I gave people for their second, third, fourth deal was 23 grand on 2022. So there you go. I'm going to give it to all you guys. You just need to literally tell myself or Connor. Both of our calendars are open tomorrow, so we have availability. If you guys don't see anything that works on the calendar for you, just text me or email me. I also take calls on Saturday and Sunday. It's Q4, so we're doing as much real estate as we can. I will drop the program fee from 25K. It's 9,500 up front, normally 15,500 due the day after you close. I'll give it to you guys for 9,500 up front and then 13,500 due the day after you close. And that's on the assumption that, we do like a 30-minute call and, we've answered all your questions and we're ready to get started. So, and we got to move. Most clients are going to need to submit offers in the next like 4 or 5 weeks. November 15th is the cutoff. But I would say onboard with us in the next like 2 weeks, 3 weeks max. But try scheduling with me for tomorrow or text me a time that works. And let's get started this week. Self-liquidating offer. Again, it's literally more expensive for you guys to do this stuff without our help. We negotiate massive seller credits. And if you guys were on at the beginning of the call, we'll literally save you 9 to 18 grand on a loan origination fee by connecting you directly with a bank and giving you guys a better rate. Got another pre-approval for, I'll pull up my text message thread with the team here. I think we got one for 6.125. Let me show this for you guys in real time here. So here's our team chat. Let me show this to you guys in real time. So you guys know I'm not bluffing. You guys can call my bluff anytime you want. If you guys doubt the validity of anything, I will introduce you to a client. I'll give you guys whatever you want. Here it is. Dave, 6.35. Boom. 6.125 from a local credit union. Throw an 8 in the chat if that's what's up. Come on. Right? Thank you, Andrew. Andrew, you're going to be my new favorite client. I know we're going to get started. It's like, are you kidding me? $0 loan origination fee and sub 6.5% interest rates right now? Come on. So schedule. Schedule. I'll give you guys that discount. That's also the discounted rate for each additional deal. So hurry. All right, it's time, sir. Cool, guys. Another 5 minutes or so. Anything else that you guys want to cover? Herbert, I know you, dude, I know you have questions. Let's use the time. Kaushik, same thing. I know you two guys are pretty intent on getting some clarity on other stuff. Let's use the time. And then my firstborn son is calling my name. He's not calling my name. He's 2 months old. But I'm ready to go hang out with him in a little bit once we wrap up. But let's use the time. Am I missing anything? Herbert, grab a time for tomorrow. Archit, yeah, go for it.
Yeah, I think I had a question on LLC that you mentioned.
Mhm.
Won't the states require you to have LLC in the state where you're buying
Nope.
or at least operating your business?
No. I think there are some scenarios where, like if you guys have established like a land trust or an irrevocable land trust, there's a better protocol to form the LLC in the state that you're buying the property. And then when it gets moved into your trust, but that's specifically like a tax planning question. It has nothing to do with the actual purchase of the real estate property. There really are no added values of doing it in the state that you live in or the state that you're buying in. Like I have clients all the time. They live in Miami, Florida. They form their LLC in Montana, Wyoming, Delaware, Nevada, and they buy stuff in Texas, Colorado, Pennsylvania, the Smoky Mountains in Tennessee, Broken Bow, Oklahoma. There's no real value add or value detractor.
Okay, thanks.
Yep. Where are you based?
I'm in New Jersey.
Nice.
Yeah.
What's your credit card number so we can get started?
Yeah. Yeah, it's 1, 2, 3, 4, 5, all the way up to 16.
Awesome.
Yeah,
Invoice sent.
thank you.
Agreement sent. Receipt received. There you
Awesome.
go. Nice.
Done. All right.
Cal asks, is average cost seg plus bonus depreciation on your selected properties is about 20% or lower or higher of the sale price? No, it's actually getting much closer to. So I'll give you guys an example. Let me pull up. Let me pull up one for you guys right now. So the gentleman who was really interested in the creative finance deal earlier in the year, the total entry on this deal is going to be like, oops, where'd it go here? 87 grand. Because again, there isn't too much to do on this post close. It's already a great performing short term rental property. So we budgeted around, plus this rather, oops, budgeted around 17,000 for this one. Net effective tax savings on this one, it's going to be around 227,000 in depreciation. So we're using an estimate of around 28% of whatever the total purchase price is. And then you also get to offset the stuff that you're spending on the home post close. Plus, you get to offset our program fee, which is normally 25 grand. Plus, you can offset the inspection report and appraisal, which come back at around like $1,200 to $1,600 on average. You get to offset the total flight costs, lodging, meals, everything while you're traveling, and then your co-host fees. So next year, you'll offset even more than that. But anyway, the net effective tax savings on this one for somebody who's in the 37% bracket range is 84 grand. And the total entry into this deal is 87, which is pretty insane. Plus, there's tons of cash flow. So that's literally more than a 100% rate of return. You're literally putting in 87 and you're getting back in year one these items. 107 plus a little bit of appreciation, equity pay down on the principal amount. But again, that's pretty negligible. Here's another deal where that was the one. Oh, that's actually another really good one. Here's one where you're putting in 180. So this is another good example. This is a different end of the spectrum. So this one's like $30,000 in enhancements post close. It's a $775,000 property for what we're getting this at. 88% internal rate of return. So you're putting in 180, you're getting 120 back in net effective tax savings, plus the cash flow, plus again some equity pay down, a little bit of appreciation in the first 12 months. It's literally for every dollar you're putting in, you're getting 88 cents back. Here's another one. This is for that person who wanted something in the Poconos, for example. So this home, we're going bonkers on the backyard on this one. We're putting in $40,000 worth of work. So check this one out. This one's still available, I think. I really want a client to submit this one. It's also one of the rare, like, newer-ish homes at the Poconos. Most everything is like much, much older. For reference, this is what all the homes in the Poconos look like. They're massive, for 4 bedrooms at 3,800 square feet. That's pretty large, right? So what we're gonna do on this one, this is somebody's existing primary residence. We're gonna completely transform this one. They've just under indexed on everything so far. So this is their living room, basement entertainment room. So again, they're just doing a lot of weird stuff, but we're budgeting, a massive budget to do the design stuff on that one. That one's going to have super significant tax savings. So net tax savings on the first year is 97. Total entry is 128 on this deal. Plus there's cash flow, appreciation, equity pay down. So again, almost 100% internal rate of return. This one, for example, I think this one I also put in a larger budget for the backyard, like 26 grand. Again, this one's a $700,000 home. This will wipe the tax bill by 105. The cash to close on this one is without a seller credit, because we're going to add the seller credit in when we finish. 105 as of right now. We're probably going to get like a $25,000 credit, so it'll be closer to like 80 all in, and then tax savings will be 105. So lots of good stuff that pencils right now. Last one or two questions. Is your average cost seg plus bonus? So so I didn't even give you the ratio. So is your average cost seg plus bonus depreciation? So that would be around, if we look at the ratio on these, it was like 286K in offset to a $700,000 purchase price. So 286 divided by 700. That's a 40% ratio. Let me pull another one just to see what that ratio actually is. 264 out of 580. So 26 out of 580. 40 to 45%, 30, I guess 30 to 45% of the total purchase price is what you get to offset. Because again, there's other stuff that you get to factor in as well. If you're spending more in the backyard, if you're spending more on the amenities, the ratio is going to go up significantly. Really good question. I never put that ratio together before. Kaushik asked to qualify for loan to income ratio. So the good news is there isn't one. Wait, loan to income. Income from you or from the property? Can you add income from stocks? I see what you're saying. Oh, dude, you make so much fucking money, you can qualify for like 10 of these loans tomorrow. The criteria is you have to have at least a like 620 credit score, and then you need to have no less or no more than a like 40%, 42% debt to income ratio. So for example, you guys can qualify for almost anything. If you make like 500 grand a year as a household, that is $41,000 a month in income. You guys would have to show that you spend like $16,000 a month in revolving debt on mortgage payments, car payments, student loans that don't produce income back to you. Which for you guys, unless you're like balling in real estate over here, I don't think you guys have $16,000 in mortgage payments and student loan debt, car payments, car notes, whatever. So no, you're good. Only your wife has an active W-2. We're in California, so the primary mortgage is pretty high. No, you're good. It's a secondary home loan product. Like we've pre-approved literally hundreds of clients in the last 3 years. I think we've only had like 2 people not get pre-approved, or maybe more than that, like 5. But they were like they declared bankruptcy in their business 5 years ago, so like that will never go away. No, but you guys, again, so long as you're making over 400 grand a year, and you don't have like crazy, crazy debt that you paid on every month, you guys will get approved like that. So you guys are good. Andrew, since these are older homes, are you buying whole home warranties or just factoring in that additional costs may come up and keep a rainy day fun? We got homeowner insurance policies and then also typically an additional short-term rental policy. It depends on how we close. There is typically a policy that's pretty substantial. Like for example, I think Joe on my team will know this because he talks to Angel at Steadily. Steadily is one of the biggest brokers in the entire U.S. for pretty much every home insurance policy, so home owner, short-term rental. I'd have to ask him, but for example, the quotes that we're getting. So let me just show you some examples here because he updates the insurance estimate because he runs it through Angel. This one will be like $3,700 a year, so this is like $300 a month for a $600,000 home in the Poconos. Broken Bow, Oklahoma is also pretty cheap, so this is like $370 a month, which is pretty good. It's a personal policy, but the coverage extends into short-term rentals, if that makes sense. Texas is super high for the taxes, and it's a little bit higher for the insurance for sure. Actually, proportionally, it's about right. For an $850,000 home, this is $5K a year. Let me show you guys a super duper big one. Where's the deal that Peter's doing? Everything, by the way, if you guys want to get something in the Smokies, super cheap. So this is a home that's almost 700 grand. Property tax and insurance is super cheap out here. Oh, actually, no, this one's a little bit higher relative to the area. They're in a really cool locale. By the way, guys, I love this deal. It's an easy, super easy, no-brainer one. My clients are like, well, it's next to a highway, and I don't want something like that. I'm like, do you want to make money or do you want to make money? This deal needs to move. We've had this one for like 6 months, and I keep it on my deal portal. Every week, every 2 weeks, I clean up stuff that's been on there for more than like a month. Try to keep it to like 50 to 60 max at a time. Yeah, so this is a $1.06 million home. So monthly payments. So yeah, I think Andrew, you just asked that. So let me give you a definitive answer. Since these are older homes. If the home is older, I think it's just baked in to like what the premium is going to be for the policy. I don't think we like switch up policies. Joe and my team would know that. I'm so far removed from helping people find insurance policies. I focus on so many other things. But I think we just do normal like homeowner insurance policies with the secondary home loan that you're getting. It extends the coverage for guests staying at the property. So it's the same policy. Yeah, we try and do a good amount of coverage and then not crazy expensive on the policy. Final round, guys. I'm going to give you guys my link again. So let's wrap it up. So Vishal, hey, Vishal, what are we doing here, sir? I want to work with you. Excited to do it. Hope you guys have availability. Would love to work with you and your spouse. Ricardo, same thing. Joe Leo, it's good to speak with you. I don't know if we've connected recently. Hari, I know we've spoken. Archant, Herbert, let's get going. Cal, good call with you. Andrew, I know you're getting started. David is also going to do this, but next year. David's also a great CPA, guys. Was just connected with him earlier in the week. He's super, super solid. Cool track record. Very, very hungry. He's probably going to be one of the other CPAs we start introducing people to. Cool, guys. I will let you guys go. Final call. Just again, knock out schedule. Put a three in the chat if you guys scheduled a call with me. Put a 4 if you guys didn't. I'm curious for the 4s. Why aren't you guys scheduling with us? Or maybe you're just lurking. Toba, nice. Jolie, good. Oh shit, we're booked out. Are you serious? Okay. Text me. Email me, and then we can manually find a time. I can take calls Saturday, Sunday morning. I'm working as well. It's Q4. I'm going to be doing that for the next like 6 weeks. And then November 15th, it's done. Andrew said, thank you for taking the time. Yeah, dude. Connor and I are super excited to work with you. So, of course. Yeah, Jolie. All right. Of course, guys. I'll throw it in here one final time. Yeah, click the link. Oh, I guess if you guys aren't seeing anything, that's not going to be useful. Let me get 1 or 2 of my other calendars and see if there's anything on there. Oh, yeah, here. You guys can grab something for Monday or Tuesday, I think. And then there was one more. I think this calendar might also have some availability. Oh, yeah. I think both of these have some. So, yeah, if you guys do want to schedule a time, just click both of these, open them up. I'm going to shut the Zoom down in like 30 to 90 seconds. If you guys have anything else, happy to support you guys. And then, yeah, click that link. Click the link, schedule. If you guys need anything else, just email me, message me. But yeah, happy to support you guys. Cool, guys. All right, that's a wrap. We'll try and get this recording live. I'll have my assistant trim the video, trim out some of the flub stuff, and then we'll upload this on YouTube, and hopefully it'll be there tomorrow or Saturday morning, so you guys can check out the recording too. See you guys. Till next time. Schedule that link. Jason, I saw that you just joined. Herbert, grab a time before you bounce, buddy. I do want to support you on this stuff. Jason, we just wrapped up. I was saying that we're gonna get the recording to everybody tomorrow or Saturday, whenever it gets live. Been on here for almost 2 hours. Cal, yep. Herbert, yep. Cool. All right, time to go hang out with my firstborn son, who's 2 months old. See you guys.